When discussing oil benchmarks, where better place to begin than Brent Crude? Taking a look at the daily chart here, we can see that ICE Brent Futures have been on a tear since early November. Like most commodities and other asset classes, the global reflation trade has driven a relentless 4-month bull trend through late 2020 and early 2021. Now, a lot of traders cashed in their chips when the market hit $70 in March, triggering a big correction in the second half of the month. However, buyers stepped up at 61.50, and after a brief period of consolidation, the market is again trending higher, albeit with less momentum. Now, if we take a quick look at the chart in more detail, we can see this is where the last trend began, and we're holding that trend line still today. This is the $70 resistance we saw, and we're testing it again now. We'll have to wait and see whether or not the market has what it takes to break out, or whether we're going to roll over and hold this channel here. Now, the question is whether or not market fundamentals and market sentiment support a grind through resistance and a breakout, or if we're going to roll over. Now, in order to test that, we can take a look at the commitment of traders on ICE Brent Futures. Now, if you focus on the top chart here on the top right, I want to draw your attention to the contracts held by money managers. And this is because a change in the balance of long and short positions among non-physical players can give an indication of market sentiment. Now, starting with the oil bulls and the net longs, we see the orange line in the top right there shows how long positions have increased in recent months as speculators jumped into that trend trade. Now, when the market hit 70, that trend broke, triggering a correction, and many of those positions were liquidated, as you might expect. Now, the deeper correction was averted, and longs are once again starting to come back to the marketplace. And critically, in the latter end of April, the longs stepped up their buying, and now we'll see whether they have what it takes to get through the resistance level. Now, quickly turning over to the bears. First of all, you'll notice that the number of contracts is considerably lower. We've got 86,000 shorts versus 391,000 longs. Now, those positions, if you look in recent weeks, or short positions in recent weeks, are starting to build again as we sort of test that resistance level. Now, that suggests that maybe some bets are coming in, that the market might start to roll over from here. Now, we saw a slight uptick in contracts over the last week or so, but that's a 6,000 change in contracts in a much larger market. So it's difficult to say whether or not the market's going to turn. Now, taking a quick look at the forward curve. This is the market structure for Brent on the top chart and WTI at the bottom. Now, as you see, the market is fairly deep in backwardation, implying there's strong demand for near-term contracts. Now, the dotted line in each case is where the market was at the beginning of April. Now, what is noteworthy is that the depth in backwardation has not really changed that much since a month ago, and that's despite the developments happening in India at the moment. So this suggests that the market is unfazed by the demand threat posed by COVID-19 developments in India, which is the third largest oil exporter in the world. Now, looking at oil supply, this is one of the key fundamental factors to watch. Now, ongoing OPEC Plus cooperation is a key consideration as traders weigh up the efficacy of the multilateral efforts to regulate global oil supply. Now, if you look at ICON data here, it shows that OPEC 10 are outperforming when it comes to compliance, with the major producers all at 100% compliance for April. So just a quick look there. We've got Saudi at the top here, producing 8.1 million barrels per day in April, more or less in line with the previous month. Now, that's a cut from 11 million barrels per day. Now, officially, the pledge cut is 1.8, but we know that they're outperforming by a further 1 million barrels, cutting 2.8 million barrels per day last month. So this gives us a 150% compliance rate. Looking to Iraq, UAE, Kuwait, these guys, all major producers, all at 100% compliance. Now, as long as this agreement holds, oil bulls seem happy to pay $70 per barrel. Now, conscious of the fact that any breakdown in cooperation will undermine benchmark prices, communication to markets by OPEC has been clear and policy intent has been well telegraphed. As per the latest agreement, we know that more barrels are coming to market, but indications from the futures prices suggest that global demand can handle it. Now, the ongoing supply constraints are critical to the market, in which demand recovery is constantly challenged by developments in the COVID-19 pandemic. And our ICON users have some fantastic tools available to them to help them track the caseload and government responses. This caseload tracker page presents a country-by-country comparison of key pandemic indicators. We see cumulative case load, we see new cases by the day, and active cases. Now, here we have the regional breakdown, and we can monitor the second wave happening in Europe at present. We see new cases in France, 26,000 cases per day. We see Germany, 20,000 new cases. Turkey also up there with 26,000. So we've got some factors to watch here as we try to monitor regional developments in Europe. Quickly over to Southeast Asia, maybe. Yeah, we see India, and the new cases continue to rise. We've got nearly 500,000, well, 400,000 as of yesterday. So it's still absolutely rampant there. Now moving over to our recovery indicators, again, we have the country by country breakdown. We've got the stringency index here, which is very important. This gives us an indication of what government measures are currently in place, both in terms of school closures and travel restrictions, and including fiscal and monetary measures as well to help contain the virus. And this has obviously major implications for economic activity and therefore oil demand. We've also got the all-important reproduction rate, the R number, and we've got the total vaccinated per 100 people to show how the recovery is underway in various parts of the world. Now here we have Europe rated by the R rate. We have to actually go down the list a little way. Here we have Germany, 0.97. Let's go at 0.97. So yeah, we see that's still below 1. So perhaps things are starting to roll over there. And then you can go across different regions. Now, we can take a closer look at India here. And this will give us an idea of how the pandemic is evolving with the historical data in place. Now, the purple line shows that the cumulative cases are absolutely soaring, and that's driven by the orange line, which is a new case load, as you can see here. Cumulative cases driven by a rising number of new cases at present. How interesting, the green line across the top, that's our stringency index. And that hasn't really moved up as the second wave takes hold in India. Now, this is good for the outlook in terms of economic activity and oil demand, at least. Now, importantly as well, we hear the red line is the R number. So that's also a sign of hope that perhaps the growth and the spread of the pandemic presently is slowing down, and that may therefore mean that an increase or further stringency measures may not be necessary, which could potentially be positive for oil demand. Now, there's a lot more to the story. And with that, I'm going to hand over to Sudarshan, and he's going to give us a breakdown of some of the India metrics right now.
Good afternoon, good evening, everyone. Thank you for joining us on this webcast. Thank you, Tim, for taking us through the price updates and what's happening with respect to the financial markets. Now, taking a deeper dive into the India market, specifically with respect to oil and gas, let's take a look at some of the macroeconomic indicators post the second wave of COVID. What has happened to the economy? So if you look at the Purchasing Managers Index on your screen, you will realize that the manufacturing and services index have started falling since about the start of 2021, which shows that the growth has started to slow down. While towards the second half of 2020, the growth started picking up, and from a contraction, the manufacturing and services index had moved into a growth area. The growth has now started to slow down. If you look at the consumer confidence index, it's a falling trend line, which indicates that the average consumer in India is starting to lose confidence, which could lead to a scenario where people go into a savings mode rather than spend, which will again put pressure on the economy and in turn on the fuel demand. Now, let's take a look at some sentiment indicators. Now, these are brought to you by Refinitiv in partnership with MarketSpsych, and they've created the Thomson Reuters MarketSpsych indices. This is based on both news and social media. So if we take a look at the optimism and the fear index, we can see that the optimism index has started falling since about March 2021, which is when the second wave kind of started to materialize in India, and the fear has started to increase. Now, this is representative of people, both what is being communicated in media and also on social media and tweets, etc. So it represents the psyche of individuals in the country, which shows clearly again in kind of sync with what we saw in the confidence index. The people might kind of go into a tendency where they start saving because of uncertainty about the economic growth, because the chart below, which kind of represents here, if you can see, the blue line represents the 15-day moving average for economic growth, while the orange line represents the 30-day average. The 15-day or the shorter moving average has started to fall, and it has cut the longer frame average. This again suggests that the perception about economic growth is pretty weak right now, which will again play on the minds of people. Now let's take a look at some mobility indicators. This is sourced via the Google COVID mobility dataset. If you can see, the data has been split into different regions where people generally commute to or are mobile. So if you look at residential areas, we've seen that the mobility was increased post-March 2020 when the first lockdowns were enforced in the country, started dipping, and at the same time office mobility started increasing as people started heading back into the workplace. But that has again stopped right now with the second phase of the pandemic starting. We see that people are now staying more indoors in their home and not going to offices and working from home. This can impact the transport fuel demand in the country. We also see that the footfalls in commercial or retail establishments have started falling, which like we've seen in the earlier slides on consumer confidence and the sentiment, which is again a reflection of the fact that people may not be spending as much. If you also look at the public transport data, that also kind of reflects the same thing. So since the start of March, people have been less mobile, which has had an impact on the transport fuel demand. This slide kind of represents what we see on the transport fuel demand. We see that diesel sales kind of picked up in 2020 towards the second half, and in 2021 we saw March had a healthy demand, but April numbers, preliminary numbers, suggest that gasoline has fallen about 14% month on month, while diesel sales have fallen about 8% month on month. And what I would like to draw your attention to is also that Q3, July to September quarter, is also seasonally a weak demand period in India for fuels, especially because of the fact that there is a monsoon at that time. And that has historically played an impact on diesel. So we'll need to wait and see the monsoon impact on demand this year. How we've generally seen that it does kind of impact the demand. So if that leads to refineries trimming the throughput, which we've already started seeing in April and expected in May, that could lead an impact on crude oil demand. Or if refineries maintain their throughput at similar levels, that could lead to an increase in exports of fuel, which could depress the Singapore margins. Lastly, I'd like to draw your attention to the crude oil imports into the country. We can see that in March of 2021, the highest imports for the year of 2021 was achieved, where the imports were at about 4.11 million barrels per day. That kind of dropped in April with about 3.9 million barrels per day. In the month of May, based on current arrivals, it is expected that the imports could fall to about 3 million barrels per day. So we are already starting to see an impact on the arrivals. And going forward, if the refinery throughput does not improve, does not pick up, that could lead to an impact on the crude oil demand. In terms of the key suppliers, we see that Middle East continues to remain a key supplier to India. However, that is likely to change with India looking to actively diversify away from the Middle East and increasingly looking towards suppliers such as United States, Brazil, etc. for the bulk of their imports. With that, I hand it over back to Tim. Thank you.
Thanks, Shashan. That's very interesting. I'd just like to share one more slide with everybody. I think just to cap things off. I think what's particularly interesting about the point you made is that India consumes imports around 4 million barrels per day. And we have the oil Refinitiv flows data for May suggesting that number could fall to 3 million barrels per day, which is no small amount. And we're talking about demand destruction of up to 1 million barrels per day there, which is essentially 1% of global demand, in a good year. So It just shows really the dichotomy we have at the moment between how bullish Brent futures appear to be, certainly in terms of where price is and price action presently, and also the sentiment in the marketplace, and where we are, where India stands presently in terms of its predicament and the potential impact for oil demand. Now, this slide here, the final one, is a Reuters poll of 46 analysts, 46 analysts, right? And we've got the 2021 average for Brent prices at presently at $64, and we see that. And that was taken at the end of April. Now, we see there's quite a big spread there, as you'd expect. We've got the lows of 50, we've got the highs of 73. So it's a $23 spread. So yeah, could be anywhere in between. That doesn't give us a great deal of guidance. But what is interesting is if we look at the top of the range, we see some pretty major market influences there. Goldman Sachs there at 73. So you have to question whether or not, if this is a 30, this is a 30th of April assessment or last updated, that these guys are factoring in what's going on in India at the moment, and yet still seeing potentially 73 average for the year. Now, given that prices are starting from a relatively low point, we're going to have to see some pretty strong prices going forward over the next few months and into the back end of the year. You can see actually here that the mean poll showing Q2 65.68, Q3 66, and Q4 65. So there's some pretty interesting indications for what may yet come. So we'll see how things develop over the next few months, and we'll be here again in the near future to give you the latest breakdowns. Thanks very much for joining us.